Good morning again, options traders. Happy Monday to everyone. Well, it's time for another one of my absolute favorite topics, the illusion of patterns. And I decided to do this because I still get a lot of emails from people asking, hey, does it look like a head and shoulders is forming or a flag, anything like that? And the reason they're asking for confirmation is that they think it's somehow predictive. And what I want to show you is that all of these patterns that you think that you see in the markets are really illusions that come from randomness. They absolutely have to occur. Now, I know this is probably going to be one of those videos that's going to get a lot of thumbs down because there's a lot of traders out there who just believe in these patterns. It's what they've been taught, it's what they teach everybody else, and they are just refusing to think that it could be false. But what I want to try to do is to show you in a couple of really interesting ways, a way to prove to you that these patterns that you think you see are just illusions. They must be there, they must be a result of volatility and randomness. So we're going to ask a really interesting question, at least one of them, is going to be what happens when you shuffle returns? So interesting question, let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, patterns. Yes, traders believe that patterns are predictive, but the shapes aren't artifacts of some type of deep-seated structure, cycles, or predictable waves. Instead, these patterns arise from randomness and volatility. Those are the only two things that you need. And we're going to find out why in just a little bit. So really, it's just one thing. It's a bell curve. A bell curve has randomness, and it also has a width, a standard deviation, or volatility. And once we find out that all of these traders who are making millions of decisions, that it effectively comes out to be random. That doesn't mean that you might not be making strategic decisions, but in the end, it all boils down and kind of dissolves into randomness. So the first thing to understand is that the shape of the path isn't evidence of forces behind the path. Those are simply stories. People say, oh, sure, well, it did this because of that. Or it did this because it was follow through. It did this because it had to fill the gap. Those are just descriptors of what happened. So they feel like they're predictive, but they're just descriptive. That's all it is. So there's a couple of ways that I want to show you why these patterns are simply descriptive, that they are not there from some economic force. And one is, as I mentioned before, shuffled returns, and number two is looking at real versus fake. So we're going to look at Apple in just a little bit, but these were the first 8 returns from this year period that we're going to look at. We got 0.0161, 0.0041, then a loss of 0.0052, and so on. Again, the first 8 trading days from roughly a year ago. So I want you to think of these as cards or pieces of paper that are in a hat. Now, for this particular year, this is just how they happen to get drawn from the hat. And so, unfortunately, people think that there's something special about the sequence, that there was some economic force that was driving it. And they therefore think that those patterns must be a result of these economic forces, and that's why they're predictive. But just understand about patterns, that any pattern that appears in randomness at the same frequency or the same rate as real data cannot have predictive power. So if you can label the past perfectly but can't label the present reliably, the model has no predictive value. And that's the simplest way to put it. So let's go see, can that really happen? Can we have just complete nonsense data and see if we can still get these patterns? And if we do, you have to really question the patterns that you think you're seeing in the market. So let's jump over to an Excel spreadsheet. All right, so here's our roughly a year's worth of returns from Apple going back to December 6th of 2024. Closing price was $242.84. The next day, December 9th, closing price $246.75. And there's the return that we saw, 0.0161. And all that means is that this price, $246.75, divided by 242.84 is 0.0161 times higher. Or if we wanted to put that in percentage terms, 1.61% higher. So we would just say that's the return of that stock for that day, about 1.61%. On the third day here, closed at 247.77. We divide that by 246.75, and the return is right there, 0.0041. And so when we look at all of these closing prices right here, we get the stock price path of Apple over the last year. Now, again, these are just the closing prices, but this is why people look at this and they say, man, look, we got support, we got resistance, we have a head and shoulders, we've got Fibonacci retracements, Fibonacci extensions, we have flags, pennants, they're all there, and they are predictive because there's some type of an economic force that's causing these shapes. Well, let's go see if we can get those same shapes by shuffling what happened. And what we're going to do here in column E is we're going to take these returns. We're not changing the returns, we're keeping them, we're just changing the order. And that's what's in here. And if we do that, we get this. And what do you notice? Looks like a stock chart. We get lows, highs, we get support, resistance, we get flags, we have head and shoulders, cup and handles, everything that you see with a normal stock chart. But hopefully you're starting to see that if this looks like a stock chart and it's really just pure meaningless noise, then why would you put so much faith in the shapes that you're seeing here? See, what's common to both of them, and which is why they have the same, let's call it the same look and feel, is that we're drawing the same returns just in a shuffled order. If I hit F9 on here, we can get a new shuffled order. Same data, there we go. Let's do it again. See, you're going to get all of the patterns that you see in a regular stock chart, even though we're just mixing up the returns. What does that tell you? It tells you that all you need is a mean and a standard deviation, and you're going to get cup and handles, head and shoulders, flags, pennants, wedges, Fibonacci extensions, Bollinger Bands. All of that is going to be in there when it's completely meaningless data. So that catches a lot of people by surprise. So what this really shows is that if the data cannot survive the test of time, being moved through time, without revealing the same patterns, then why would you say the patterns are meaningful here? Now, once again, sometimes traders will say, well, okay, but we know that people aren't just picking stocks and whether to buy or sell at random, and so I still believe that these have meanings behind them. All right, well, let's just hold that thought for a moment. Let's call one a real chart and one a fake chart. And the question we want to ask now is that if you can't tell the real from the fake, what does that imply? So to make the point, let's say I put two coins in front of you, one is real and one is fake. And you look at them and you go, they look an awful lot alike, I can't tell them apart visually. You flip them over, look the same, they weigh the same, you inspect them closely, no matter what test you put them through, you cannot tell them apart. Well, what does that tell you? Well, therefore, seeing a coin gives you no evidence that it's real. And that's really how it works in the stock market. So let's go back over to the Excel spreadsheet and see why that's true. Now we're back into our Excel spreadsheet, and now we're looking at coin flips. We've done this before. I did a little tweak to them here. I did them in log terms, so it will make it a little more realistic. And so if we look at this, these are simply coin flips. And what we've done is that, let's say if it lands heads, we're going to increase your starting price, which is right there, at 100. We're going to increase it by 1%. And if it turns out to be tails, or a 0 over here, you're going to lose 1%. And then we're just going to do a log transform on it. I'm not going to get into the technicals for that, but it's going to make it a little bit more realistic. And then those are the prices that we're seeing over here. So watch what happens if I hit F9 now. Look at that. We still get head and shoulders, flags, pennants, wedges, support, resistance, Fibonacci extensions, Fibonacci retracements, everything that you see in a stock chart. So once again, this is completely fake. It's completely made up. What gives it the feel of a stock chart? Two things, a mean and a standard deviation. And that's really all that we need to see to get something that looks like a stock chart. This is amazing. Look at these, all these flat lines. Look at this support. People say, oh, this is a very strong support down here. I know that I can buy down here because it's obviously going to bounce. Well, that's not true. This is completely made up. You're going to get support and resistance levels from completely meaningless data as long as you have a mean and a standard deviation. That's the common theme. So let's do a couple more. So once again, if you can't tell it apart from the real, then why would you want to give credit to the real and say, therefore, it must be some type of economic force that's driving it? So just remember, when it comes to randomness, random data produces head and shoulders, flags, pennants, ABC waves, everything that you can see in a regular stock chart. So therefore, observing a pattern in stock prices provides no evidence that a non-random force is at work. It's just like the two coins. Seeing a coin doesn't mean that it's proof that it's real. And the very easy test is that if you can't tell it apart from a fake, you have to be real careful in saying that it's evidence that there's some type of predictive force. There are better ways to approach the market, and that's one of the main reasons you have to understand options. But if you're using options as a way to try to get rich quick by trying to predict what stocks are going to do, by looking at the pictures they create, you're simply looking at cloud formations and hoping that it works. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.